Everyone's rushing to bonds right now. And I'm going to show you exactly why that could be the most expensive mistake of your retirement. Look, the 30-year Treasury just crossed 5.1%. We haven't seen that since before 2008. The 10-year is sitting at 4.6%. And all week, in every comment section, every forum, every email I get, same question, should I dump JEPI and just take the guaranteed 4.6%? I get it. I do. You spent 30 years building this. You're 55, maybe 62, maybe 68. The news is a nightmare. And here's the United States government handing you 4.6% guaranteed. No drama, just income. But here's the thing, the safe choice and the smart choice, not always the same thing. So stay with me, 15 minutes, because I think this is the most important conversation about retirement income I've had on this channel all year. Now let me tell you what's actually happening, because context matters more than the headline. 5.12% on the 30-year, 4.6% on the 10-year. Best on the long end since before the financial crisis. Why? Inflation is still sticky. Kevin Warsh just got confirmed as Fed chair. And traders right now are betting not on a rate cut, they're betting there's no cut at all for the rest of 2026. Some are even pricing in a hike. So when bond yields do this, spike like this, it creates a real dilemma. The math looks clean. Honestly, almost too clean. $500,000 in a 10-year Treasury at 4.6%. That's $23,000 a year. Guaranteed. No stock market. No volatility. No monthly swings. Just a check. And JEPP? You're holding it, maybe loving it, maybe starting to wonder. It's yielding around 8.4% right now. Same $500,000, that's $42,000 a year. But it's not guaranteed. The distributions move. The price moves. And yeah, in a rough month, that check shrinks. So the fear is real. I'm not going to sit here and dismiss it. I've been getting emails all week. People who've held JEP by 2, 3 years, love the monthly income, suddenly second-guessing everything because of a Treasury headline. That's human. That's completely human. But making a $500,000 decision based on 1 week of headlines, that's exactly how expensive mistakes happen. Here's where I need you to think differently for a second. When you buy a 10-year Treasury at 4.6%, what are you actually buying? You're buying nominal 4.6% before inflation. And right now, inflation isn't cooperating. If it averages 3% over the next decade, which is a pretty conservative call given what we're looking at, your real return on that Treasury is about 1.6%. 1.6. Congratulations on your safe investment. Meanwhile, what has JEPI actually done? 5-year annualized total return, 8.38%, including distributions. In 2024, total return was 12.56%. In 2023, 9.83%. And 2022, one of the worst bear markets in decades, JEPI lost 3.49%. The S&P 500 was down over 18% that same year. Now, does that mean JEP always beats bonds? No. Does it mean JEPI has no risk? Absolutely not. But here's the question I actually want you to sit with over a 20-year retirement. What's more dangerous? JEPI's volatility, or $23,000 a year that buys a little less every single year until it's worth almost nothing? Okay, I promised you a fair comparison. So let me be honest about what JEPI actually is. JEPI holds about 120 large cap S&P 500 stocks, low volatility, quality names. And every month, it sells call options on those positions to generate premium income. That's your 8%. Not magic. Not some sketchy strategy. Option premiums. But here's the catch. When you sell a call option, you collect the premium upfront, and in exchange, you cap your upside. Market rips 20% higher? JEPI doesn't capture all of it. The call options are a ceiling. Think of it like owning a rental property. Your tenant pays rent every month. That's your JEPI distribution. But there's a clause in the lease. If the neighborhood booms and values jump 30%, your tenant gets to buy it at the old price. You got the rent. You missed some of the boom. That's covered calls. So what are the actual risks? 3 of them. Risk 1, distributions fluctuate. Calm market, low volatility. Option premiums shrink. Your monthly check gets smaller. Turbulent market, like right now. Premiums expand. Income spikes. It breathes with the market. It is not a fixed coupon. Risk 2, upside is capped. Ripping bull market. JEPI lags the S&P 500. And here's something people miss. Covered calls don't protect you from a sudden drop. Gradual decline over months? Yes, some protection. A fast crash in March 2026? JEPI and JEPQ both took hits. That matters. Risk 3, and this one catches people off guard. Tax treatment. JEPI distributions run 60 to 80% ordinary income, not qualified dividends, ordinary income. In a taxable brokerage account, you're handing a chunk of that 8% straight to the IRS at your regular rate. Hold it in an IRA or a 401k, problem disappears. Hold it in taxable, your real yield is meaningfully lower than 8.4%. Yield looks great. Tax bill doesn't. So yes, JEPI has real risks. I'm not hiding a single one of them. But now let's actually compare apples to apples. Here's the question nobody's actually asking out loud right now. If you lock in 4.6% today and inflation stays at 3.5%, how much is that retirement paycheck actually worth in 10 years? I ran those numbers. Hang on. $500,000 on the table. 2 options. Option A, 10-year Treasury at 4.6%. Year 1, you get $23,000. Feels solid. By year 10, that $23,000 in today's purchasing power, about $17,100. By year 20, $12,700. And when the bond matures, you get your $500,000 back nominal. But in today's dollars, that principal is worth roughly $277,000. Upside participation, 0. Option B, JEPI at 8.4%. Year 1, you're pulling $42,000. Could be $36,000 in a quiet market. Could be $48,000 when volatility runs hot, like right now. 5-year average annualized total return, 8.38%. Price can grow within the limits of the covered call structure. And if you take even a portion of that excess income and redirect it into SCHD, a dividend growth fund, you built a 2-engine machine. One engine pays your bills today. The other fights inflation for the next 20 years. And here's something that gets lost in this whole conversation. The 10-year Treasury right now, 4.6%, is below JEPI's worst-case yield, even in a calm market. And we are not in a calm market. Geopolitical tension, tariff uncertainty, a brand new Fed chair, option premiums are elevated, which means JEPI's distributions right now are near the top of their natural range. So you're being offered risk-free 4.6% at the exact moment JEPI is paying a dynamic 8.4% in conditions that specifically favor covered call income. But wait, does that mean bonds are useless? No, not even close. There are real scenarios where treasuries are the right call. And I want to be honest about them. Short-term need, something you have to pay in the next 12 to 24 months, medical costs, a known expense, caregiver costs. You can't afford to have that money fluctuate. Treasury. Done. Already generating more income than you need? Great problem to have. Lock a portion in for pure capital preservation. High tax bracket and you want state tax exempt interest? Interest. Treasuries qualify. JEPP does not. But here's the scenario I think is the actual mistake right now. Locking 30 years at 5.1% and calling it a plan. If rates fall, and eventually they will, you've surrendered all of your flexibility. Stuck. and a dynamic income vehicle like JEPI. Dawn traded away for a number that felt safe in May 2026. The best construction I'm seeing isn't JEPI or bonds. It's treasuries for the 1 to 5 year bucket, the money you absolutely cannot lose. And JEPI or a JEPI and SCHD blend for the 5 to 20 year bucket, where your job is to beat inflation, not just survive it. 2 jobs. 2 tools. Not an either or. So, should you dump JEPI for bonds? Here's the actual answer, not the clickbait version. The real one. If you're holding JEPI inside an IRA or a Roth and you're relying on that income to cover your living expenses, the current environment is working for you right now. Higher volatility, fatter option premiums, larger monthly distributions. This is not the moment to panic out. But if you're holding JEPI in a taxable brokerage account, you need a clear-eyed look at your tax rate. Because ordinary income treatment at 60 to 80%, it shaves real money off your effective yield. Depending on your bracket, you might be looking at a real yield closer to 5 or 6% after taxes, which changes the math. Here's the framework. 4 steps. 1. Check your account placement. JEPI belongs in a tax-advantaged account. If it's in your taxable brokerage right now, that's the first thing to address. 2. Be honest about your income needs. Do you actually need every dollar of that 8.4% to live on? Or do you have some margin? If you need every dollar, the fluctuating distribution is a real risk, and you need to acknowledge that, not paper over it. 3. Build the 2-bucket approach. Short-term treasuries 2 to 5 years for your certainty bucket. JEPI or a JEPI and SCHD blend for your income and growth bucket. 4. And I mean this, don't make a $500,000 decision based on 1 week of headlines. The 30-year Treasury at 5.1% is a data point. Your retirement is a 25-year project. Those are not the same conversation. Look, I started this video by saying the safe choice and the smart choice aren't always the same thing. And I want to end by being honest about what that really means. There's no perfect answer here. JEPI is not perfect. Bonds are not perfect. The investors who make it, who actually keep their income and their principal intact across 20-25 years, they're the ones who understand what each tool actually does. Not what the headline yield says. Not what feels comfortable when the news is bad. What the data shows over time. The 30-year Treasury at 5.1% is seductive. I get it. But locking in 4.6% nominal, income that loses to inflation every year, no upside, no flexibility, that is not a retirement plan. That's a way to feel safe while your purchasing power quietly disappears. JEPI in the right account as part of a real strategy, it's a legitimate tool. 8.38% annualized over 5 years. Monthly income. No K1 headaches. And distributions that expand exactly when markets get scary. Which, if you hadn't noticed, is right now. So no. Don't dump JEPP for bonds. But understand what you own. Know which account it belongs in. And build for 20 years of income needs, not 1 week of scary headlines. If this was helpful, hit like, subscribe, drop your questions below. I read every comment. And if you want me to break down the 2-bucket strategy with actual allocation percentages, specific numbers, not vague concepts, tell me in the comments. I'll build that video next. See you in the next one. This is not financial advice. Past performance does not guarantee future results. Consult a licensed financial advisor before making any investment decisions.